Good afternoon, everyone. Welcome to another one of our Wednesday market reviews. It is Wednesday, February 26th, and my name is Stock Darts. If you like what you see today, you can always follow me at Stock Darts on Twitter. You could find me on YouTube at Stock Darts, or you could visit me at patreon.com/StockDarts, where I post weekly blog content. Typically, I'll post a watch list idea or a trade idea on a Monday or a Tuesday, and then repost these Wednesday market reviews on Wednesdays, and then maybe post an update or a summary of our trades during the end of the week if a particular trade warrants it. Uh, we have an interesting week. We did not meet last week. I was on vacation. I was off skiing, and I was expecting a bit of a market drop last week, and we did not get that. But we did get it this week, and it's been pretty sharp and pretty drastic. And I would say at this point, it's pretty safe to say that the market character has changed quite a bit from the last couple of weeks to what we are seeing right now. And I would imagine a lot of you guys that are in here are probably a little bit worried as to where we're going to go next and what's going to happen next in the market. So we're going to spend a good portion of today discussing what can happen and how we're going to move forward and where this market can go leading into the middle of March or so. Now, one thing I want to say, for those of you that are regulars, you'll know that I basically like to work with technical analysis. I like to ignore the news for the most part and just trade based off of what the chart tells me. I feel like a lot of times the chart will give you a good synopsis of what the market is doing and what the news is. Now, that doesn't mean that the news isn't impactful, as we can see right now. Obviously, coronavirus news is strongly impacting the market, but what I've found to be the case more often than not is that the the market, the technicals, give us a better idea of how the news will impact the market. I'm not saying that the news doesn't impact it, but there's a lot of times where if the market is still in kind of an upward bias and still searching for sellers, it will ignore bad news. And when it's finally ready to drop, that's when the bad news really affects it. And I think that's what's happening right now. Is it's a combination of a market that was ready for a pullback and ready for a correction, along with news that is basically allowing it to correct it probably more sharply than it would if the news wasn't around. Hi, Ray. Good to see you in here. Good to see whoever else is in here as well. Hopefully you guys have had an okay week. Those of you that follow me on Patreon know that this week we're being a little cautious with our trades and not really getting too aggressive with the markets, but hopefully everyone's having a good time and not suffering too poorly from what we're seeing right now. Now, as I was saying, the markets, when the market has a drop like this and when you have a news event like that, when you actually see the drop, that's usually a combination of a couple of factors, and one of them is a market that was ready to drop to begin with. And those of you that were following over the last couple of weeks, you'll know that we've been noticing these rising wedges in the market, showing a market character, that a market is starting to get stretched out and starting to get a bit overbought. And we were anticipating a pullback of a decent size, but not quite as quickly, not quite as drastically as what we've seen over the last couple of days, particularly what we saw yesterday. The move on Monday, while still a little surprising, wasn't that surprising to me because, again, as you can see here on the SPY chart, we had this rising wedge, and then the correction really was just a couple of candles, and then we had another rising wedge form. And while that one had a more appropriate correction for the type of price action it had in the short term, in the intermediate term, I don't think we really still had enough of a retracement to get enough of a reset where there were new buyers coming in and new sellers stepping out. And that's really the way you should always look at the market, is in terms of buyers and sellers. A lot of times when we look at these candles, we look at these trend lines, it's easy to just look at it as a chart and say, well, we've got green candles, we've got trend lines that are marking the tops and bottoms of these candles, and you tend to forget exactly what this chart represents. And this is really a picture of buyers and sellers in the marketplace. This isn't even really a picture of the S&P 500 as much as it is of the attitudes of buyers and sellers as they regard the S&P 500, right? And so when you look at a trend line, what you're really looking at is sentiment. You're not looking at a connection of dots. You're not looking at just candles that are connected because we felt like we're connecting the dots and filling out a coloring book like we're 5 years old. No, these trend lines are telling us what investors and what traders think about the S&P 500. And obviously when it's going up, they have a bullish bias, and when it's going down, they have a bearish bias. It's the same thing the moving averages tell us. Now, when you see something like this, what we're finally getting is we're finally getting the buyers are losing control of the market, and the sellers have finally come in and taken advantage and presented too much supply for the buyers to be able to go through. And that's why we have these drops. And like I said, a lot of times you'll need a news event to eventually push it through where you have when you have these kinds of imbalances, because basically the buyers have been ignoring bad news for a while. It's not like the coronavirus all of a sudden appeared over the last couple of days. It's gotten worse, and there's been more cases of it in different countries. But the truth is that we had a coronavirus scare a few times already, and the market just shook it off because the market wasn't ready to correct. There were still too many people that wanted to buy, and there wasn't nearly enough supply or enough distribution levels to push the market down. But we finally reached the point where buyers think that the market is overpriced, particularly within the viewpoint of what could be a slowing market economy if the coronavirus continues to escalate and continues to spread. Um, and that's why we finally had a drop, was because we reached the point where the market was no longer a value, and then the news was sort of the catalyst that forced us to push backwards. And I understand to a certain extent. Some people may disagree with me, some might agree. But that's my view on the way these things work. And it's worked well. It's served me well for almost a decade now. And I really, I've found that generally speaking, if I just trust the chart, then I won't be surprised by the news events, because the only time the news events will really affect the market is when the market was ready to pull back. Now, of course, that's not always going to work, right? If there's a war that comes out of nowhere, if there's some kind of natural disaster that comes out of nowhere, then yes, it's going to impact the markets, and the technicals will not be able to really predict it. But for the most part, and I've seen this quite a bit over the years, even when it was something like the Fukushima nuclear reactor meltdown, where you have an event that comes just out of left field that should impact the markets, and the market shakes it off because the market is not ready to pull back, right? And so that's one thing I want you guys to really take out of this, is that yes, we're pulling back. Yes, there's a coronavirus scare, but the truth of the matter is that the market was kind of ready for a pullback to begin with. Now, if we look at the long term, and before we get into anything of the looking at technical levels and looking at what the price points are that we need to watch, I do want to step back and take a look at the long-term chart of the S&P 500, just to give you a better idea of where we stand. Because I know a lot of people, if you're a trader, or if you're someone that's just an investor and has your IRA account and that's what you're worried about, the first thing you see when you have a drop like yesterday, and I'll have that a lot of times, my parents will come and they'll call me and they'll ask me questions. They'll be like, well, the Dow is down 1,000 points. What's happening? And I'll point out, well, yeah, there was a scare and the market's dropping. But if you take a look at where we stand, even after that drop, compared to where we've been over the last couple of years, the market's still in a pretty healthy state. And you have to understand that when the market goes, and again, we're looking at the S&P 500 right now, but we'll look at the Dow in a little bit. SPY was trading in the 290s just towards the end of last year, and we've run up all the way up to 340, right? Now, at some point, the market has to pull back. It's not going to always go in a straight line up. And when you get these pullbacks, people get scared because they're pretty drastic pullbacks. And I'm not trying to discount or underestimate what's happening right now. It's a pretty ugly drop. But when you look at it from the larger time perspective, you realize that we're just retracing part of the move that began in October of last year. So we're really just maybe halfway from the rally that started down here in the 290s, 280s. And we're still above 300. We're still above 310. And overall, we're still in a pretty good spot. If you look at the S&P 500, the daily chart, which is what we're at right now, yes, we've gone past the 20 and the 50, but we're still well above the 200-period moving average. There's still room to pull back and still be in a healthy uptrend. Now, that doesn't mean that this room to pull back isn't affecting people, isn't causing them to lose money in their accounts. But when you think about it, the money that you've lost in your account over the last 3 days, it's money that you gained over the last 2 or 3 weeks, or even in the last 2 or 3 months, that you didn't have prior to that, right? So if we go back and we take a look, and your account was basically in the same spot towards the end of last year. So it's been a month, it's been 2 months now, and we climbed upwards and we've lost it now. The bad part is, of course, we lost it in 4 days, and that's pretty scary. But that tends to be the nature of the markets, where you have these stairs that you take going up, and then when you come down, you take the elevator, right? Especially when you have the strong moves down. So what I'm getting at, I guess, is I don't like what I'm seeing. I think the market character has changed, But I also don't want you guys to panic and think that we're in a bear market, that this is 2007, 2008 again, or that this is, 2000, 1987. We're not in a crash state yet. We're just in a market that needed to correct and was getting way too ahead of itself. And you could tell it just by looking at this price action. You can see these rising wedges, and you can see the impact that the sellers were making was pretty minimal. And when this happens, and this is something I've discussed quite a bit because I look at a lot of charts that have these sort of patterns. You have, like I said before, your buyers and your sellers, and when you have these rising wedges, what ends up happening is you get this imbalance because there's more buyers piling into a stock and there's less sellers having an impact on the stock. And so what happens is the higher and higher up that the buyers pile in, they're the weaker buyers that keep chasing the price action that aren't waiting for value. And those are the ones that are going to abandon their stocks first and jump out. And so what happens is this is kind of a market's way of correcting and kind of like a survival of the fittest type of behavior where the smarter money is going to take money away from the dumber money or the weaker money. And so what happens is the people that have less discipline and chase the price action upwards are going to be the ones that basically capitulate and give up, and then the smarter money that's waiting for value is going to come in and step in at these levels and repurchase the market. And so now our job as traders is to figure out when is the smart money going to come back into the market. Are they already coming back in today? Are they going to come back next week? Are they going to come back in a month from now? Are they going to come back in 5 months from now? We don't know. I suspect that it won't be that long, but for the moment, I haven't seen enough price action, obviously, to say that buyers are stepping back in. And I think the market has flipped. Over the last 5 or 6 months, the market was looking for sellers, which basically means that the buyers are in control. I think at this point it's pretty clear the sellers are now in control, and they are looking for buyers. And so that's what we're doing. We're looking to see where the buyers are waiting to step in and support price action. And that's going to be basically the theme of our Wednesday market analysis probably over the next few weeks, as we watch how price action develops and see whether the market is ready to start turning around and climbing higher, or whether we need to turn and trade sideways, or whether we need to head down lower and explore even lower price levels. And I think at this point, it's pretty clear that we don't really know where it's going to go yet, but what we could do is form some plans and try to figure out what we'll do depending on what scenarios play out, right? So that's what we're going to do over the next probably 25-30 minutes, is take a look at these 4 major market ETFs, the S&P 500, the NASDAQ, the Dow Jones, and the Russell 2000, and we'll identify levels that we think might be important and what we can expect price behavior-wise from these indices as they approach those levels. All right, so as of last week, or the week before that, I had mentioned that there was a possible head and shoulders developing, and this 320 would have been the neckline. You can see we had a move up, we came back, and then we moved up, and then the idea was that if we came back and tested that neckline, the next bounce, if it was worse, would have led to what could possibly a head and shoulders top and a rollover. Now, that didn't work out, and that's okay. That was kind of a theoretical idea that may or may not have played out, and I didn't really expect it to play out, but it was something I wanted to watch because I was already getting a little bit worried about the way the market was behaving. Now, the fact that we moved and sliced right through it yesterday probably negates that potential pattern, but it does give us an idea now. We have an important price level that we can expect to serve as resistance if we do, or when we do, bounce back to that price point. And that's going to be 320, and then right above it, this gap area around 324, 325 is going to be critical as well, right? So what we have here is we have a price zone that I anticipate will be difficult for the market to push back through until we have more substantial price action and we have a new flip between the buyers and the sellers, where the buyers take control of the market again. So this is the key area to watch. If we are looking to figure out when the buyers have taken control of the market again, I think it's going to be when we can get through this price point. I know it's kind of wide between 320 and 325, but these are the two areas that I think we're going to need to work our way through and start to come up and fill that gap. And I think even once we fill that gap, we're still not really out of the woods. But I think if that gap, once that gap is filled, I think it will have proven that the bulls have taken control of the market action again. Now, what typically happens in these scenarios is we will probably spend a couple days trying to find support here, and then what often happens when you have such a strong move is you eventually do one of two things. Either one, you spend the next couple of weeks trading within that big candle, and that often happens when you have a massive candle like this on such big volume, is that you spend the next week or two trading inside that candle. But the other thing that happens is you trade a bear flag, and then you continue along the previous path, which would be down in this case, and maybe come down and head towards the 200 period moving average and test this area right around 307 to about 303, which, as you saw on the weekly chart, is kind of an important price point, right? So I think those are the two likely scenarios that we have to watch for over the next couple of weeks. Is one, we have a bounce up into this 320 area, but really can't push through it. And then either resume back to the downside or continue to trade within this big candle. And the other is that we just kind of trade over the next couple of days, don't even make it up to the 320, 325 area, and then roll right back over and test the 200 period moving average and start testing lower price points. And I think both are pretty much the same likelihood of either one happening. I suspect more than not we will probably head lower, just based off of what we're seeing. But there's always the possibility that the bulls step in and try to defend price at this point and try to move it back upwards. And so those are the two scenarios that I'm looking at. Now, as far as how to trade this, I think we're a little early to figure out how to trade. I think at this point we're still in a step back and observe mode. I will say one thing, and we'll get into a little bit more detail once we cover the four major markets, but at this point you have to imagine to yourself, what's the big threat, right? It's the coronavirus. So you have to ask yourself, if there are more cases that pop up, let's say a bunch of them pop up in New York, right? Or let's say a bunch of them pop up in one of the other major cities in the country, how will the market react and what stocks will react to that? And I think that's how we need to approach trading, is at this point in particular, is there are names that I like that I will get at discounts as we move forward, but I'm not ready for that yet. What I'm looking at right now is, once we do get a bounce, if we get more bad news, how is the market going to react, and how will I look to trade that? And we'll get into that again as we cover the four major markets, and once we get to the chart request, I'll explain a little bit more of what I mean by that, and what kind of game plan I have. But as far as what I'm looking as far as trading right now, I'm not that excited about trading this market. Those of you that are on my Patreon, are subscribers to my Patreon, you know that I only offered 2 trades on Monday, and they were both selling volatility, looking for stocks that might trade sideways into this event, right? As we started to drop, we had a big escalation in volatility, and options prices usually get pretty inflated at that point, and so I sold volatility on a couple of plays. One is working very well. One of them is down, but I still have next week because of the versatility of the play. But overall, I didn't want to trade this directionally because there was the potential of what we saw yesterday. And there's the potential of what we might see over the next couple of days, which is a further drop. So I think at this point, you're not really best served in trying to trade too strongly directionally. I think at this point, the best ideas are probably to take advantage of the escalating volatility through options plays, or you wait for stocks to come back up into resistance, and either you short them, or you wait for stocks that consolidate and set up for a bounce play and then play them off of that. Now, the other thing you want to do at this point, like I said earlier, is you want to look at the FANG stocks. You want to look at other names you really like, stuff like Amazon, stuff like Facebook, and you want to identify support levels that you think you like on these, and you want to watch for buying candles to step in and tell you when you want to buy these stocks. Because again, when we have these types of corrections, that's where you get value. That's when you get stocks that come back to support levels, right? So if you were worried about Apple, you didn't like buying it at 330, you feel like you missed it in the low 300s maybe, go back and take a look at a weekly chart of it. Or if you feel like you missed it way back here in the 230s, 240s, it's probably not going to come back down to that level. But if it does, then you realize you have an incredible discount, and you should be able to go ahead and pick some up if you're looking to buy that in the long term. Now in the short term, if you're still just looking for a better price point, maybe you want to look at it around where it's now. Maybe you want to look at it when it comes down to the 270 area. But what you want to do right now is you want to build a watch list of stocks that you like, that you feel like you didn't get when they moved through. There's always names we all miss that we like. Something like Tesla, where you feel like, oh man, I missed an opportunity on this stock. And it obviously something like Tesla doubled, right? But it's a stock that you missed, and these pullbacks are going to pull them back, and the stocks are going to correct towards other previous levels of support. And you want to build a list of what prices you are comfortable picking up some of these stocks at, if they end up correcting back to those price levels. And that's one of the key things you want to do when a market is doing what it's doing right now is you want to watch and see what are the stocks that I missed out on or stocks that I wish I had more of at a certain price and add those to a different watch list and keep that on there. Um, and so that's one of the things that you should be doing right now rather than trying to panic and trying to figure out how you want to get out of this market. Now, that being said, you do want to reduce risk. And I know it's kind of late to say that after we had yesterday's drop, but when we do get a bounce, and if you see the market starting to struggle as it comes back up, then maybe you want to reduce risk by closing out some of the trades that you think are more volatile and more dangerous to hold, or whether it's by selling calls against positions, or whether it's by buying puts, hedging with a market short, anything along that nature that you feel you'd be comfortable doing in order to protect yourself. Because I do think there's a chance that the market continues to at least probe lower and search out where the buyers are willing to step in. Now, there is the one other scenario, which I think is unlikely at this point, but which could happen, which is where the market just says, you know what, we don't care. This was a temporary scare, but we're going to shoot right back up and start pushing to highs. And if that's the case, and that happens and you feel like you miss out on a bounce, it's no big deal because we have so many levels of potential resistance now, whether it's 320, whether it's 325, whether it's the gap at 330, whether it's the other previous highs at 338, that there will be a point, even if we get a snapback bounce, where the market will stall out and you can go ahead and re-enter off of a momentum play once it hits one of those levels and prints a bull flag or something. So I would not be worried right now about missing out on a bounce. I'd be more worried about protecting my account and protecting my capital and making sure I put myself in a position where if we continue to drop, I'm not going to be hampered too severely by losing trades or by losing money in my accounts. Now, those of you that are long-term traders, you understand to a certain extent you just have to weather this, right? If you're holding these in your IRA and you don't have anywhere else to move your money that's productive, you can't really do much, right? Because if you close this out and then you take a couple months to get back in and we do come back to highs, you end up missing out. And like I said before, when you're a long-term trader, these drops are the price you pay for holding it during these nice movements that we get in the market, right? We've had a lot of scares in the market, and the market still has eventually kind of forged through that and continued higher. And so despite the fact that we've lost half of what we've moved from, say, October of last year to now, well, we're still up from October of last year, right? We're still up a decent amount. So that's part of the price you have to pay. I'm not saying not to be proactive in managing your risk, but just understand that that is part of what happens and part of the regular market behavior when you're in it for the long haul, as many people are, particularly with the retirement accounts. All right, so now as far as the S&P 500 is concerned at SPY, like I said, we've got our clear levels, right? We understand what to expect now. If we start to lose the 200-pair moving average, if we start to fall back into this area below 300, I think that's when it's the next warning signal that the market is definitely in more danger than what we're seeing right now. I think at the moment, in the short term, it's an ugly market, but I think in the long term, we're still pretty healthy. But if we lose 300, then I think at that point I start to doubt the long-term health of the market, or at the very least the intermediate-term health of the market. So I think that's a crucial level, down here around 302, 303, 301, and that would be a very, very significant level to lose on the S&P 500. And if we lost that, I would start to get a lot more worried than I am right now. I think right now this is just intermediate-term fluctuation. I think it's pretty critical and pretty volatile correction, and you know it's kind of scary, but this is all still part of normal market behavior, and I'm not that worried about the long-term health of the market. I think it's just a short-term sort of storm that we need to weather. But if we start to lose into the 303, 302 area, and we start to drop into the 290s, I think that's a little bit more worrisome. And I think at that point, we need to worry about the potential of a market continuing to drop, or at the very least being stuck in another sideways mode like we saw for the last 2 or 3 years. And like I said, we have our clear levels that we need to work through, which is 320, 325, and then 332. Now, if we look at the NASDAQ, we're going to see a very similar pattern. A little bit more relative strength. And I think the NASDAQ was the one that really showed us the potential that we had for this. It's basically been doing a rising wedge for a while now, right? And just like the S&P 500, we have these two rising. Really, the S&P 500 had three rising wedges, but we've got this drift up and very minimal correction, drift up, minimal correction, drift up, and then we finally had a strong correction. But if you look at this correction within terms of the move from 237 and starting all the way down here at 195, well, we really haven't corrected even half of that move yet, right? And so we're still in a pretty strong market. We're in a market in the long term that is still holding up well, and particularly with the NASDAQ and with the Qs, the moving averages are still all pointed upwards. We're starting to see a little bit of a downturn, but they haven't crossed. We're nowhere near the 200-period moving average. So I think in the long term, if you really look at it, we're not in a spot right now where we need to worry too much about a long-term correction or a bear market. Again, if you look at the weekly chart of the NASDAQ, you see where we stand. Now, of course, all bear markets, all corrections begin with a swift drop, right? So I'm not going to go ahead and say that it's impossible that we're entering a bear market, because there's a small chance that this could end up dropping all the way down to 190s, and then eventually we have what could be a topping situation. But I will point out that in the long term, we have a lot of damage that needs to be done before this bull market and before this rally is really threatened as far as a technical perspective is concerned. We had this strong base that we spent the last 2.5 years in. We had the nice breakout, confirmation of the breakout, and then we had the strong rally upwards. And while we have corrected over the last few days, we're still within really a pretty strong uptrend in the long term. And I don't think at this point that trend is really in danger. I think what's really in danger right now is just the short-term behavior of the market. And so, what we're going to do right now is, like I said, we're looking for names that we want to buy at a discount, because I think ultimately we will get a good buying opportunity in the next week or next 2 weeks once we have a bottom develop in the market. Now, the bottom could develop over the course of the next week. It could maybe take another month and a half to develop, but we will see a good bottoming pattern, and we'll see the ability to go ahead and start buying names again and trading back to the long side. And as long as we don't fall below some of these lower levels, and on the NASDAQ, it's way down here. It's below the 200-period moving average. It's down here in the 190s. Until we see price action at that point, we have to assume the market is still in a strong uptrend, and it's just correcting. And it's going to need to correct for a while to kind of offset the drastic drop that we've seen over the last 3 or 4 days. But I think overall, it's still in a very healthy place, and it's just a matter of us waiting this out and understanding that these types of drops happen when you have a market that starts to get a little too stretched out and a little too overbought. And of course, when that coincides with strong news events, that's when you get these ugly drops that really scare traders. And when you watch the news, you'll see basically they'll be screaming that the sky is falling, but that the news is, their number one aim seems to be to scare people, because that forces, that kind of makes people watch them, and really they're about getting viewers. They're not about trying to give you good advice. And so you might see otherwise on the TV, but if you really look at it and just look at the market with your own two eyes and try to approach it from a logical standpoint, you'll see that despite the fact that we've had a really ugly drop, in the long run, we're still not really in that bad of a shape. And I think that's really the key, is you want to have that confidence in buying when we get dips to good support levels. And the way you get that confidence is by understanding the bigger picture and seeing where we stand compared to where we've been over the last couple of years, where we've been over the last 5 years, the last 10 years. And, whenever you have that doubt, just go farther back on the chart, right? Here's a look at the weekly chart. Here's a look at the monthly chart. And the farther back you look, the more you understand what this market is doing and where we've come from since 2008 and 2007, 2009. And you can see where we've come from. And yes, eventually we will have to retrace a big portion of that. But until we do, we'll just keep taking advantage of this upwards momentum. And it really starts with this: watching these pullbacks, understanding that they will occur, and instead of being scared of them, waiting for the right opportunity to beat the smart money that gets in at good value areas. And that's what we need to be doing again. All right, now, technically speaking, the levels we want to watch on the NASDAQ and the Qs are a little bit different from the S&P 500. Like I said, we've got a level here around 210, which is kind of it's a temporary level. It's not as substantial as what we have here in the 206 to 200 area. I think that's the key area. If we go below 200 and we start to head into the 195, 194 area, I think that's when we have to really worry about the health of the market. Until we do that, uh, I think we're still just in a correction of a pretty volatile nature, but in an uptrending market. The big thing too is we don't want to see these moving averages turn back and head back south. I think that would be kind of critical. And to the upside, I think the key area here is, again, we have basically 225 or so, the bottom of this gap, and then the top of the gap around 230. If we get a kind of a lukewarm bounce, I think that's where we should expect to see some selling pressure, and likely we'll come up to that area, then roll right back over. And it's the same as the S&P 500. Either we stay in between yesterday's candle, or we print a little bear flag and then head south and start probing a little bit lower and figure out where the buyers are. And if we do that, I think that we will likely find buyers somewhere around 210 to 207, and probably a little bit ahead of this area, which is kind of an important launching point for the rally that we had as we closed out last year and started this year. Now, if we look at the Dow Jones, it will be very similar to what we saw in the S&P 500 and the NASDAQ, but you can see we have some relative weakness here. We're already at the 200 per moving average. We are already at the price point that I would be worried about with the S&P 500 and the NASDAQ, and that is the top of this area where we kind of confirmed the breakout from the range that we spent basically all of 2018 and most of 2019 in. And you can see where we stand right now. We're right back into this area. That's not a good sign. That is definitely something to worry about. However, I feel like the S&P 500 and the NASDAQ are more critical in this respect than the Dow Jones. I think some of the components of the Dow Jones have struggled recently, and because of that, it has shown relative weakness. But overall, it's mimicking what its other two stronger peers are doing. And as you can see, it's doing sort of the same thing. We had a drift up, and then we had a correction, then we had the wedge up, and then we had a stronger correction showing the relative weakness. Then we had basically another wedge up. Right? And then we had the drop, which eventually accelerated into what we've seen over the last few days. Now, just like the others, the idea is either we stay ranging between this candle, trying to explore the top of it, or we print a bear flag and then roll right back over. In this particular case, obviously the bear flag would be pretty scary, because that would lead us even further down below the 200 per moving average and into more critical areas from last year, which really we're better off not trying to explore at this point, right? And so that's a negative, and it's one of the signs that maybe we are in for a more protracted correction, or more prolonged correction than what we're seeing right now, is the fact that we already have the Dow Jones back into this level that we spent a good part of last year establishing as new support, right? We had it as resistance, and we spent a good portion of the end of last year establishing that that was no longer resistance and it should be support, and now we're kind of breaching it back and trying to hold as support, but we're not really doing a great job of it at this point. So this is not good. Again, the head and shoulders that was developing has been invalidated by the fact that we broke down below or quicker than it could even form. And at this point, I would say that this is a very critical level of resistance, and I doubt that the Dow Jones will be able to push through this area here at the beginning of the gap around 282 to 283 and through into the top of this gap. I don't expect us to be able to fill that anytime soon, and I suspect that this will be a very strong level of resistance. And so, like I said before, I think that in the short term and in the intermediate term, the market has definitely changed in character pretty strongly, and at this point we can assume those are strong levels of resistance that we will have a lot of trouble getting through, at least on our initial bounce, whenever we do see our initial bounce into those areas. And I think that we're going to have to take probably a couple months. Maybe we're going to have to wait for our next FOMC meeting, maybe for next earnings season, before we can really push through these levels, or we're going to have to see a drastic change in the news that we're seeing across the world for this to happen. But for now, I suspect that this will be very stiff resistance, and we will have a little bit of trouble breaking through that. So this might end up changing the way we approach the market and changing the way we try to trade, because the environment right now has changed dramatically from the environment we saw in January and in the beginning of February. Now, the last one we have to look at is the small caps. And IWM is in a lot of trouble right now, and this is really unfortunate. I think this right here is the biggest sign that we are probably done rallying for the near future, and are probably going to trade sideways, if not continue heading further south. Unfortunately, as you look at the long-term chart on this, this level here to me has been extremely critical on the Russell 2000. This 158, 159 level on IWM. It was very critical. It was what was holding us back throughout all of last year from really getting a strong rally. And we were finally able to break through it, and the market rallied very strongly alongside this. And we were actually getting close to actually making new all-time highs on IWM. IWM has been relatively weak for quite a few years now. And it would have been nice. I think if we could have made new highs on IWM, it could have led to an even stronger rally than we saw over the last couple of months. But alas, it was not meant to be. And with the drop we saw yesterday, you can see IWM is now right back below what is to me a very critical level that I think really shows us the risk appetite of the market. And the fact that we're back below it obviously shows that we are in a risk-off environment, which again means the market is not willing to accept risks and is looking at the moment to protect its capital rather than trying to expand and gain rewards, right? So now that we're back below that, that's not good, right? So what do we do from here, right? We have the 200-period moving average. I think if we want the market to, if there's any chance that the market's going to rally here, the first thing that's going to have to happen is IWM is going to have to make its way back above 158. I suspect that won't happen. I suspect that this will be a pretty stiff wall of resistance for the small caps. And if that's the case, I think this lends credence to the idea that we will have a bear flag and then drop even further to really figure out where the buyers are willing to step in and confidently support the price action in the markets. If we do make it back to 158 and start to approach the upper edge of yesterday's candle, then I think that's a positive. I think that's actually a very good sign that the markets are shaking off what was what could maybe be a temporary scare until we get more drastic news. And if that's the case, then I think the other indices might start heading into some of those gaps that we were talking about. So again, if you're worried about the market, I think IWM is one place to watch. I think ultimately the key ones to watch are the S&P 500 and the NASDAQ. I think as long as they stay above those critical support zones that we were talking about, then the long-term health of the market is okay. But if in the short term, if you're trying to figure out where the market's going, IWM is not a bad one to look at because it's been leading the way down in particular. And if we start to see some strength come back into it, that might be a sign that some of the other indices are going to kind of outperform it and start moving upwards as well. So the key area right now, I think, is 158.50, basically 158, 159, and then the 200-period moving average, which is where we are right now. If we fall below the 200, I think we're going to head quite a bit south, maybe down into the low 150s. If we can get back above 158, I think that's a strong positive, and likely means we need to come up and start testing the top of yesterday's candle. But that's a lot for some of the other indices. That's not a tall task, but for IWM, that's actually a pretty big order for it to try to do that. So I don't expect it to come back to this area anytime soon. I certainly don't expect it to fill this gap anytime soon, and I expect that it's going to struggle in this area for the next few days and probably head south first before it tries to make its way back north. But overall, as long as it's below 158, I think it's pretty safe to assume that the market is at the very least in sideways mode and more likely than not still searching for lower support levels. If IWM can get back above 158, then I think that's a positive, and it will mean the market is not searching lower and is probably either just expanding sideways or has already started to bounce back upwards. So that's a critical level. I think it's one of the more important ones. Now, if we do lose today's lows and yesterday's lows, there is room for us to drop all the way down to last year's lows, which is very, very scary, and we would not want to see us down here. But at the very least, the midpoint, somewhere around 152, 151, is likely a point that we can actually head all the way down to. And like I said, it's not a good spot to be, and it's something that's a little bit worrisome if you are looking at the health of the market. So that's kind of the thing that we need to watch for right now is how much fear is still in the marketplace. And I know that you have the fear greed index and you have other things, but I find that a lot of times IWM gives me a perfect idea of how much fear there is in the market versus the other indices, because typically this is the area where the more volatile assets are. It's the area where traders, when they're aggressive, they want to buy the stocks that are going to move the fastest, and that's typically the small caps. And the same as it's been for a while now. They have one foot out the door, and the first place they leave is the small caps, and that's what we see every time we have selling in the market. It's always more exaggerated in the small caps, and that's still the case. And so we'll see more selling come in here before we see it in the other indices. All right, so that's the four major markets. I think overall we're not in a good place to trade right now, at least to not trade aggressively. Personally, I am focusing more on options and trading volatility. I know that's not something everyone can do. If any of you in here want to learn more about options, you can always approach me about mentoring. I do teach options. I've taught options quite a bit over the last 10 years. I do earnings workshops where I teach people how to use options to trade earnings, but I also just teach people if they want to learn how to trade in a non-directional manner. What I mean by that is you don't necessarily need to trade everything up and down, right? You can actually trade a market that's sideways by just taking a bet that it's not going to move anywhere by selling volatility with premium. And you can do it in a way that has defined risk. I know a lot of people always get scared about selling volatility because they say, well, you're picking up a small amount of premium and you're risking a lot, but that's not necessarily the case. There are ways of reducing your risk through iron condors, through calendar spreads, through butterflies, where you actually have very minimal risk for the premium that you're trying to take in. You don't have to expose yourself to ugly moves in the market. And so if you have any interest in that, feel free to ask me, and I'd be more than happy to help you with that and to teach you how to do it. If you follow me on Patreon, you'll know that I've been putting some educational posts on how to take these trades over the last couple of months. And hopefully some of you guys have been able to profit off of that. Now, let's take a quick look at the U.S. dollar, oil, gold, silver, and then we'll move on to the chart request. I see Jimmy James, you've got one on play. We'll take a look at that. Anyone else that's in here, we actually have 10 viewers, which is a decent amount for me. If you guys have anything you want me to look at, feel free to put it into the chat, and I will be more than happy to take a look at whatever charts you guys are looking at and give you my thought on it. It could be a chart. It doesn't have to be a stock that you want to take a trade on. Maybe it's something that you want to try to figure out where a profit level is or where a stop level is, and we can go from there. Now, as you can see, the dollar has been on a pretty nice run over the last couple of months. It did pull back sharply over the last week, and a lot of that has to do with the fact that the euro finally gained a little bit of traction. I think overall the euro is still struggling dramatically versus the U.S. dollar, and that is one of the big reasons the U.S. dollar has gone from about 25.90 to 27 on the UUP index. If we take a look at the euro U.S. dollar cross, we will see that the euro has indeed struggled, and it did get a nice little bounce here, but this bounce is really just one of these, I don't want to call it a dead cat bounce, but kind of like a dead cat bounce where it's just coming up into a previous level of support, and it really needs to push past this area between 109 to 108 in order to get higher and try to establish a new bottom, because it is again starting to roll over, which is leading to a lot of strength out of the U.S. dollar. You can see it here in the long term, what the euro has done. Now, keep in mind this chart is based in euros, so down is good for the U.S. dollar and up would be good for the euro. And as you can see, the euro has really struggled versus the U.S. dollar. And that has led to some U.S. dollar strength across the board. Now, if we look at the U.S. Canadian, again, we'll see the U.S. dollar picking up strength. We had a little pullback as it approached resistance, and it's making its way back up towards resistance and trying to break out. So again, this is another chart that's showing us that the U.S. dollar has actually acted strongly, despite the fact that maybe over the last couple of weeks it had a little bit of a pullback. It is behaving pretty well and is acting strongly. And if we look at the U.S. yen, we'll see something similar, where the U.S. dollar actually had a nice breakout. And while it did pull back over last week, I'd say overall, this is still a pretty bullish chart because we just had the breakout. Unfortunately, it faded the entire breakout, but it's trying to confirm the breakout by holding above this previous level of resistance and trying to turn that into support. So overall, I'd say that the U.S. dollar is behaving pretty well, and you would think that put a strong impact on gold and silver. But the truth is, gold and silver have broken out over the last couple of weeks as well. You can see gold broke out nicely, and silver broke out but faded and pretty much gave back the entire move. I think of the two, gold is clearly still the precious metal you'd want to be involved in. One thing I will point out is when you see U.S. dollar and gold strength together, um, a lot of times it's a sign of weakness in the market. It's because money's flowing to safety. And it's not always the case. We've had a couple of weird fluctuations where gold and silver rallied together over the last few months where we couldn't really figure out what was going on. But I think in this particular case, with the volatility coming in, I think money's flowing to safer spots, and that's part of the reason that we're seeing the U.S. dollar pick up strength with gold and silver. Now, in the short term, they're still kind of fluctuating along their inverse relationship, but they're both generally kind of moving up together. Um, and I think that they're both in a pretty good spot. Obviously, you can see GLD had a nice breakout from this consolidation range and made new highs. And while it's doing what gold always does, which is it consolidates in these really volatile ranges. But you can see it found some support as it continues to break out. It came back and pulled back, but it didn't pull back all the way down to this level of support around 148, 149. It's holding up around 153. And I think overall, if you're in gold right now, you're probably in a good spot. I know, Ray, you tend to trade this a lot, and hopefully your trades are doing well for you, or at least coming back from some of those areas you were at before. But it looks like gold and silver are doing pretty decently. And then the last commodity we want to look at is oil, which is not doing well, and is struggling pretty well. And this is to be expected with the coronavirus stuff, because there's less of a demand for energy if you have transportation areas shutting down. You have factories in China that are slowing down. People are going to be flying less. People are going to be taking cruises less. Stuff like that. You're going to see oil continue to slow down, and you're going to see demand for oil slow down. And I think that's what we're seeing right now. And it's had a very drastic drop. And I think this isn't all coronavirus, of course, but we've seen a dramatic drop in oil. It finally had a bit of a reactionary bounce, but it's come all the way back down to this 50 area, and it actually made new lows today. And this, of course, is also the inverse of the U.S. Canadian, which we saw earlier. And I think at the moment, if you want to, oil's not a good place to be. It's probably a good spot to look at some shorts as well. And if you are looking for areas of weakness in the market, or weakness that might happen because of the coronavirus, some of the energy names are a decent spot to look at. We were looking at Exxon the other day and how poorly it's done. You can see the big drop-off it's had recently, in particular over the last 2 or 3 days. It's really cratered, and I think a lot of oil names are going to be in similar places. And if you're looking for weakness, if you're looking for a place to short when we do get a bounce, I think oil and oil-related names are going to be one of the areas you want to watch. All right, let's take a look at the chart requests, and then we'll wrap it up in a minute. All right, so Jimmy James, you want to look at Dave & Buster's. So this actually leads to one of the thoughts that I have on when we opened up the stream, and I mentioned having a trading plan as far as how to maneuver in this market in the short term. And like I said, I wanted to build a watch list of names that I like and names that I don't like. Tell me, Jamie, is this a stock that you are looking to buy? You just want my thoughts on it, or are you in it and you're kind of worried about it? And while I wait for your response, I'll elaborate on what I mentioned earlier. So when I was talking about building a watch list of names that I like, I also mentioned that we have to have an idea if the market is dropping off of coronavirus scares and we get a bounce in the near future, and then let's say after that we get more worse news, right? We get a bunch of cases pop up in New York or another major city. Maybe they have to quarantine another cruise ship or something along those lines. Well, what do we want to do? So one of the things you want to do is you want to figure out, well, what are the areas that will do well or do poorly if we have another big more of a coronavirus scare. And so something like this, Dave & Buster's is an entertainment company. Obviously, it revolves around people coming out and going out and interacting in public. It's dropped a lot. I'm not saying it's just because of the coronavirus, but it's had a pretty drastic drop. And so, Jimmy, you want to look at buying this, and so we'll get into that in a second. But I just want to elaborate on my position a little bit. So you want to look at names if you're worried about the coronavirus. you want to look at names that either do well or do poorly. So uh, one of the things you could do is, so say cruise lines. Cruise lines are getting hammered because people are going to be scared of going out on cruises when there's a pandemic going on, right? So take a look at what has happened to Norwegian or Carnival Cruise Lines over the last couple of weeks, right? And if these things come anywhere back to these price points, and we have another scare, they're going to drop even further. As it is, they could even continue to drop from these levels. So you have stuff like that. You have stuff like airlines, which are going to get hit hard based off of worries of people not wanting to travel because of stuff like that happening, right? So if you're trying to figure out where to go, maybe you want to short stuff like this. Now, obviously, it's hard to short now. They've been down drastically over the last 3 or 4 days, but if we get a bounce, if some of the coronavirus stuff starts to kind of, fade a little bit, and we get a bounce, and then all of a sudden there's more news coming in, well, you know where to look that day, right? The other thing you want to do is maybe look at some of these names that are flu companies, that whether they're just connected or whether they actually have something that could help in developing a cure for it or a vaccine that do well. Look at something like Novavax always does well whenever there's a flu scare. You have, well, I'll just go through these. You can see the big moves that they've had recently, and a lot of these are kind of phantom moves that will eventually disappear once the scares are gone. But they trade very strongly when you have flu scares. And so you can look at some of these and see how they behave when the market is in these sorts of scenarios, right? There's quite a few of them, and they've all done very well, and they've all been very volatile over the course of the last couple of months as the coronavirus has come into the news. So, there are a couple of different ways you can approach trading this kind of market, and you can find plays if you understand what you're watching for, whether it's news-based or not. And so in this particular case, if you still think the coronavirus is going to have a big impact on where we're going in the near future, well, there are ways to target it in a more specific manner rather than just kind of being scared about what the market's going to do to whatever your long-term holdings are. Now, to go back to Jimmy's Jimmy's thoughts on play, or my thoughts on play, let's take a look at the weekly chart. I do not like buying off of these strong drops, right? I hate that because there's usually when you try to buy off of a drop like that, you're early if you don't wait for a confirmation. So if we look at the weekly chart, you can see that this level here around 38 is a pretty nice support level, right? That's a floor. So we were discussing earlier stocks that you like or don't like. If you like a stock, you want to look for value. You want to look at where people consider this to be a floor, to be a good buy, right? And so it's pretty clear that this has been a pretty decent level for Dave & Buster's for a while, right? You can see 38 has been considered a value buy on Dave & Buster's since way back in 2016. You had support here, came up, support, and then support throughout all of last year. So it's pretty clear that's a good support area. So that's a good spot. If you want to look at buying this, you know that buyers will defend it in a couple of dollars, right? From $39.60 all the way to $38. So you know that there is a support level you want to buy once it comes down to that level. Now, we're pretty close. Now, the key here is you don't always buy something the minute it hits your support level. You still want to see the buyers step in and support it. So you want to find, at this point, you want to start watching for a buy pattern, whether it's two hammer candles forming like a tweezers and then a move past it, whether it's a triangle pattern, whether it's an inverse head and shoulders, a cup and handle. You want any kind of a pattern here that tells you, what buyers have taken control and are ready to start supporting price action. And then from that point, you can start looking up and trying to figure out where your target levels are. And I'd say that there will be target levels somewhere here in the 41 to 42 area, and then another one around 44, and then obviously up here about 47. But for now, with this 3-day drop, you don't normally get a V-bottom where it just bounces right back up. So I think that there's going to have to be some kind of support level. Now, the other thing you want to keep in mind is they have earnings in 1 month. That's a decent amount of time, so you still have time to play with it. What I might recommend in these situations is if you are comfortable with options is you might want to do some kind of an option spread, taking advantage of volatility right before the earnings event, right? So you can look at selling. You can maybe even do a calendar spread where you sell prior to the earnings and you buy the earnings um, the earnings option, because that's going to lose volatility or premium a little bit slower because you'll have IV creeping in from earnings. There's a lot of things you could do with options that could give you a better chance of taking advantage of this drop without having to wait for a reversal. But if you're just buying stock, I think you need to wait for a reversal pattern to develop. I think you need to wait until you have something, some kind of a pattern tell you that the buyers have taken control. And at the moment, that is not the case. So I think that if you wanted to play this, you're still early. I think you're still way too early on this. Uh, I like the level that it's approaching, but I don't think the pattern is here yet. Now, the pattern could develop in 2 days or it could develop in 2 weeks. And that's kind of the key, is waiting till you see a pattern that you could kind of um, depend on and you can expect to kind of push it through. Other than that, the only way to really play this would be, like I said, through options. And there are a couple of ways of playing options, because when you have these kind of drops, the options prices are going to be inflated, and there are ways that you could go ahead and take advantage of that. All right? And Ray, you actually sold some J Nugget. I'm glad to see that. Um, you sold at 105. Wow, you top ticked it. That's pretty nice. Uh, good job, Ray. That was actually, yeah, that was actually perfect. Obviously, you couldn't get any better than that. You still have some, I'm assuming, but hopefully it gets you another bounce in the near future. As you can see, that's the thing with these triple leverage ones, is when you do get the sell-offs, they give back a lot. So even though they do have nice moves up when the momentum's working in their favor, when they sell off pretty sharply as well. And you can see the big difference in this versus GDXJ, where, well, I guess it's not that different, but you can see it's holding up kind of towards its recent highs instead of below them, right? You can see there's a little bit of a difference between where they are. But good job with that. Hopefully it works for you. You're playing JDST now, so you got another one. So now you're playing the bear side. You know, Ray, I think you're better off if you could short them both. They're better. You're better shorting these types of. You know, I've gone over this a bunch of times with you. I really don't like when you play these triple leveraged plays. I think you're getting yourself into trouble. I've told you this before. It could work out well for you if you time it right, but more often than not, these things decay and go in the wrong direction. As you can see, the longer you go, the worse. You can see they have to reverse split over and over in order to work. You're better off shorting these than you are going long. And I'd focus on that if you could. If you could find the shares to short, just short these. You know, if you're long JNUG and you're long this, you're doing the wrong thing. Okay? You're saying, so you're just day trading and not holding it. If you're just day trading it, that's fine. Just make sure that you don't do what you did before, where you hold a day trade longer than you need to. Okay? All right. Well, I want to thank those of you that participated today, and those of you that came. We had a nice amount of viewers today. If some of you have a question that you didn't want to ask in public, maybe you can always DM me on Twitter. You can find me on our Discord chat. You can email me stockdarts at Gmail. I'd be more than happy to help any of you guys whenever I can, and give you any advice that you need that you maybe don't want to ask in public. If you need a chart request, I can always just send it to you on Twitter. Anything along those lines. Hope you guys have a good rest of the week, and we'll meet again next Wednesday.